This is Making Better Decisions. I'm your host, Ryan Sullivan. Decisions are where rubber meets the road for organizations. Each week, we'll be learning from people who are on the front lines of turning raw data into better outcomes for their organizations. This show is sponsored by Canopy Analytic, helping companies make better decisions using data. Hey, everybody. Welcome to another episode of the Making Better Decisions podcast. Today's guest studied accounting and finance at the University of Wisconsin-Madison. His career has covered investment banking, private equity, and now analytics. He co-founded Show You Health, a nutrition-focused telehealth platform. Please welcome Director of Data Solutions at Optimal Blue, Brennan O'Connell. Welcome to the show, Brennan.
Hey, Ryan. Thanks for having me. Really appreciate the time and looking forward to talking data. Usually we're doing this just with folks in the mortgage industry. We've got our own podcast at Optimal Blue, which I'm sure I'll plug a couple times during this recording, but really good to be talking to you and as more of a data generalist.
Yeah, absolutely. Glad to have you on. I think it will also be cool. One of the things that I love about having folks from different sections of analytics come onto the podcast is we get to learn about different niches and how different industries are using data and analytics. So let's start off generally. What is the one thing you wish more people knew about using data to make better decisions?
I do some presentations for different trade organizations in the mortgage industry, and they're centered around this concept of data as a general purpose technology. And I think that actually that kind of goes back to what you're getting at here, which is what is for data kind of like a key issue, or what's an important challenge to overcome when using data. And I think it's just identifying it as a general purpose technology. What I mean by that is the ability to collect, organize, and then access large amounts of data that's representative of a market as a whole. That's a relatively new technology, and it's a general purpose technology. You couldn't do this 100 years ago for the most part. It's really the advent of computers which allows you to do it. And it's a general purpose technology that you need to build reports or applications on top of in order to get value out of it, right? So if I just have a large data set, that's great, but I need to build a reporting structure and ultimately a decision-making structure around it so that when I'm analyzing the trends, whatever that nugget is out of that large data set, whatever that nugget is that's relevant, I need to be able to pull that information out of the large data set. Probably need a data visualization tool. Maybe you need a software platform with some analytics built in that allows you to do that. And then you have to have some decision making around it. So the data's got to drive actionable decisions, and you have to have appropriate reporting as sort of that application or middle layer between you and the data set.
There were a couple things there that I want to pull on it. Starting with the first, you talk about describing a whole market, which is, I think, for an analytics professional, an exciting concept. Most of the organizations that I talk to have capabilities that are strong in either the describing their market, i.e. looking at third-party data, their competition, their purchasers, things like that, or they have strong capabilities at describing their own performance, kind of first-party data. And there are a couple recurring things that are just hard, right? Business is hard. Otherwise, everyone would, just be rolling in it. And I think one of the most recurring ones is this idea of connecting disparate data sets. Now, whether this is like siloed across an organization or in different tools or what have you. And I think that this problem becomes its most difficult version when we talk about data internal to an organization and compare that to data external to the organization. So I was wondering if you could talk to me a little bit more about, sure, third-party versus first-party data, but as it pertains particularly to describing a whole market and a given company's place within it.
I do think you drew an important delineation between kind of like your own data, what's going on within your own four walls, and then third-party information, sort of like what is going on within the market. And the two data sets uh, on their own are both valuable, and you can derive insights within each. So, like for example, within your own four walls, it really becomes an operational improvement or an efficiencies question. So, if I know in the just stick to the mortgage industry, if I know my pull through rates on loans, if I know turn times on underwriting, and I'm tracking that for myself over time, I am able to track whether changes that I'm making internally are improving those operational functions, which will ultimately make me more profitable. So you've got your internal data set, and then the external data sets are typically you're going to have to go out and find those somewhere else. Your competitors aren't going to give you all of their information, so somebody's collecting that data somewhere in the market, and maybe it's a trade group, maybe it's another data vendor, maybe there's some sort of like nonprofit organization that is able to go out and generate surveyed responses and collect market data, whatever the case may be. There's this other third party data, and that to me really comes down to sort of like pricing's a big one, but just kind of like your relative position within the market. So you can compare your own internal data set against what all of the market's doing too. And then the important piece is like putting those together so that you actually know, like I'll go back to that other example, like for example, within the mortgage industry, like I can see my own pricing on loans, but I need to be able to see it relative to all of the other industry participants pricing on loans in order to determine whether or not my pricing is competitive. Maybe I did some operational things internally that allowed me to bring pricing down, and that's great. And I would know that with my own data set, but I need that third party data brought together. And this is to my earlier point about how you build out the application layer within your data infrastructure. So you got to collect all the data, but then you got to do something with it. And doing something with it is very oftentimes putting together these disparate data sets into a report so that you can analyze what's going on and get that transparency you're looking for.
Obviously, analytics is an ongoing journey. I think the projects that I've seen go most sideways share in common the idea that whatever we're doing is just like one and done thing. We're gonna build this report and then we're good on reporting. There's no, it's just the market is constantly changing. The questions which are currently important to us are constantly changing. It's best executed very iteratively. To that end, I think that you certainly don't want to focus on, well, here's the end all be all. And if we're not doing this, right, if we don't have like this holy grail data set, application, report, decision, all this kind of stuff built that completely describes our company accurately and completely describes the market and the relation between the two, then it's bad and we're doing everything wrong, right? That's definitely not the idea that I want to give. I've met loads of organizations that are very profitable, very successful, that are one of those companies that really understands the market well or really understands themselves well. But there's always room for growth. And I think that you're absolutely correct. You kind of are guessing or answering questions with incomplete information if you don't have at least some element of the balance. So, for example, you talked about product pricing. I can kind of guess that my pricing is out of whack based on my purchasing data, or possibly by putting different prices in different places and comparing them. Yeah, we can get towards some of the truth, but if we can't look at the pricing for other vendors that might be in a similar space to us, we're kind of just guessing and checking. And I think when I talk to a lot of people about using data to make better decisions, people are making decisions. They're making them. It comes down to, can I make them faster or more accurately with the assistance of data. And I can get to what is a really good price for right now much faster if I have both third and first party data connected. So I love that point. And I think that that's something that we haven't gotten the chance to give enough coverage to. So I appreciate you bringing it up. When you first answered the question, you made a distinction between two things that I'd love to dig into a little bit more. I've never quite heard it put this way. You talked about the reporting structure, and then you separately mentioned the decision making structure. And I love that. And I wonder if you can give me a little bit more color on how those things are separate.
Absolutely. And I even want to double click on something you just mentioned and sort of the way we talk to our clients about the sort of spectrum of usage of data. I think of it, data is sort of like, I mean, at its most fundamental level, it's an observation of reality, and it gives you better insight or better visualization into what the world is around you in whatever, right? Whether you're setting mortgage pricing or making a decision on healthcare or determining where to, this is sort of an off-topic one, determining whether where to drill for oil. I covered a company in a previous life that had a bunch of data on oil wells, so their business was all around getting data to energy companies for deciding where best to drill for oil. So anyway, that those observations of reality, it's totally a spectrum, right? I think of, if you're driving a car or driving a boat or something, which, is an analogy for the decision making you're doing within an organization. The data and the level of data and reporting that you put in place just further enhances how well you can see in front of you, right? You're going to have to make a decision. You're going to have to turn the wheel regardless of whether you can see what's in front of you or not, but you're going to be able to make a much better decision on where to turn if you can see what's in front of you. And that's what data does. It gives you the line of sight into what is going on around you so that you can turn the wheel appropriately. So back to your question about delineating the reporting structure from the decision-making structure, I think that's something that we see that's fairly common, where there's multiple layers. You got to collect the data and store it. That's step one. You have to build some reporting structure around it so that it becomes human readable, right? Charts, graphs, reports, whatever that looks like. That's step two. And then step three is you have to turn whatever you're seeing from those reports into some sort of decision-making plan. And so, like, how can two and three kind of get broken? Because you sort of think, like, it's like, well, obviously now that we know that our pricing is wrong, of course we're going to change it. But that's not always the case. Maybe the individuals within the organization who are looking at the reports are not the right people. Maybe those people are just data analysts and they don't have decision-making authority. And the people who have decision-making authority do not have frequent enough communication with the data analysts. So that would be one way, so that the chain is sort of broken, so that there's not this feedback loop of data and decision-making. Another one could be, you've got reporting, but you haven't defined your KPIs. Hey, we want to be at least in the 75th percentile for mortgage pricing. Well, if you haven't decided that, or you haven't said, well, I want to have at least X volume of mortgage loans, if you haven't decided that, then whatever you're seeing in the reporting is going to be insightful, but it's not going to drive a decision. Or you're always going to be thinking, well, what is the decision I should make based on what I'm seeing? It's like, okay, well, this is helpful information. Great. We were the 80th percentile in terms of pricing, or we're the 60th percentile in terms of pricing. Is that good? I don't know. Every organization has to decide, is that good or not? And then they have to adjust accordingly. So you have to set your KPIs as well to ensure that you're adjusting yourself based on what you're seeing in the reporting.
Yeah, I like your analogy with the car and the boat. I think there is one element that sometimes gets overlooked, right? The entire business doesn't pause until, some decision in some department is made. So, like, that boat or that car, it's moving. Even not turning the wheel is a decision.
Right.
And that's, I think, comparing what we're doing, whether that's investing in an analytics initiative or making a decision around pricing or whatever the decision may be, pausing or not making a decision right now or at all, that is still a decision. Um, One of the other things, the reason why I was so interested in talking about the difference between the reporting and the decision making layer, and for long-time listeners, this will, I know I'm beating a dead horse, but there are a certain group of organizations that I've encountered that do some flavor of reporting and analytics. And what that looks like is, okay, well, we have these regular reports, whether it's like, the weekly past due report or, what did we sell last week, whatever, right? Some, report or set of reports, and they can be in any platform, in any format. They get generated and sent out, like typically via email, and either don't get read or people are like, huh, okay, and then go back to doing their job. And there's a part of me that says maybe it's okay that, something's going out rather than nothing. But I will say with a really fine edge on it, if reports are generated and either faster or more accurate decisions and actions don't get taken as a result of that report, it was a waste of money. So for maybe one of those organizations that's self-aware and says, hey, we know that we're doing this, we want to get better, we have some reporting function, we're getting something out the door, what advice would you give to them to improve that decision-making layer where the return on investment lives?
Maybe I'm oversimplifying, but I think it is relatively simple. I think you start with the decision in mind and then you work backwards, right? So like it's a waste, to your point, if you're generating reporting that isn't going to impact a decision. So like let's use like the driving analogy. I'm in a car. There's a reason they put mirrors on the side. There's a reason they put mirror here so that I can see directly behind me. There is not a lot of effort in a car to try to generate data about what is right above you, because that does not impact where you are turning, right? There's not a mirror that allows you to see the sky because it does not matter to you. So generating, it would probably be distracting while you were driving. If all of a sudden you were getting a whole bunch of information about what was going on directly above you, you don't need that information when you're driving the car. So there is no effort to gather data about what is going on right above you. It's important to see the windshield, the windshield needs to be clear. It'd be very silly if that was opaque. You got to have windows on the sides. You got to have mirrors that see on the right and the left, seeing your blind spots, and then you got to see directly behind you with your rear view. But you don't need to see what's right above you, and you don't need to see what's right below you, right? Like there's not like a why isn't there a mirror, or not a mirror, but why aren't there windows on the floor of your vehicle? You don't need to look down when you're driving. Doesn't matter.
Yeah.
So I think you start with the decision that you're trying to make, and then you build the reporting. You figure out, it's like, okay, I know what the decision is. I need to know what that reporting looks like. And then you kind of work back. So now I'm at step 2. It's like, okay, well, I need to see this report. I visualize the report. It's like, okay, well, I know what this report is. And now I got to go get the data for it. Maybe that data is internal. Maybe that data is external. And then I go get the data for it. So I think you work back when you're setting yourself up. It's step 3, decision making. Step 2, reporting. Step 1, data. And then again, obviously the actual process is going to go the other way when you're operationalizing it. But I think you start with the end in mind.
Yeah. That's rock solid advice. I try to follow, and I typically advise exactly the same thing. I also want to thank you for providing us with this car analogy, because it is the gift that keeps giving. So I will continue with this. There's sometimes a disconnect that I experience relative to this idea that I was talking about, like the separation between the reporting and the decision-making layer of a bigger picture item, which is the idea of like, well, we need to be doing data, we need to be doing analytics, we need like a data strategy, but none of that, or not enough of that, is sufficiently connected to the business strategy. What is the goal? And to use the car analogy, are we driving someplace because we need to be there at 8:15, or are we just going for a Sunday drive? And as much as I love a Sunday drive, in business, we're usually driving someplace to be there at a specific place at a specific time. And so without that, if I just say, all right, well, I'll just get in the car and drive, well, I could end up anywhere. So, like you talked about, I need to use all of the information, whether that's a GPS or looking at other cars on the road or the weather or the traffic information, whatever that is, I'm using all of that to achieve the objective of being at the specific place at the specific time so that the goal gets met of being there, as opposed to just kind of being a little bit more whimsical. I'd like to shake up a little bit and talk to you about how data gets used specifically in your industry. You've talked about the mortgage space. I think it's something that a lot of people have some familiarity with. People typically either have a mortgage or at least think about getting one in the future. So we have some sort of familiarity with it. But I'm wondering if you can fill in some of the color behind the scenes and tell us about how data is useful in ways that we might not know.
Absolutely. So it may be helpful to give a little bit of background on Optimal Blue here too. We're principally a software company. So it's a SaaS business. The platform, the primary platform is what's called the product and pricing engine. So this is the tool that basically the origination community uses to set up their pricing so that when a loan officer is interacting with a borrower, they're able to give accurate pricing. So we have this platform and we are processing somewhere between a third and 40% of all new originations in the country on our system. And so you can think of it like, for folks that are maybe not familiar with the mortgage industry or familiar with this tech stack, it's a bit like the data that we generate as a byproduct of the use of our system is almost like a bit like the ADP payrolls report, right? So like ADP is this big HR oriented platform. And because they have such a large market share, they are able to generate a representative data set about the labor market because of the use of their software. So through the use of our software, we're sort of able to generate like the equivalent of like the ADP report on jobs. We're able to do the equivalent on a variety of variables in the mortgage market. So some basic areas would be like the amount of loans being originated, the rates that are being locked by borrowers, basic characteristics around credit score, and then information that is kind of like geography specific about all of those topics. So you can see, hey, is the Northeast seeing higher volumes of lending right now than the West Coast? Things like that, right? So you can answer those kinds of questions in the data set. So that is the type of information that we're able to gather at Optimal Blue. And so we're in this kind of unique position, lucky position that we have this very rich data set. And so I think a lot of I give this context because it's relevant to how folks are using the data. So in the mortgage industry, what are some of the key areas that folks would care about from a competitive standpoint when they're running their business? And our clients are really the mortgage originators, those folks who are interacting with the borrowers and originating loans. What do they care about? Well, they care about their margin. So they need to know, am I setting my margin at a place that puts me at a competitive spot in the market? And the flip side of that is volume, right? So you kind of have this price elasticity question, margin and volume that basically determines the profitability for a lender. And because we have this rich data set that tells you about where loans are getting locked, at what rate, and like the volume of loans that are getting locked, it really helps originators move from where they might have been 20, 30 years ago in terms of price setting. You might have gone on a few people's website and said, well, so and so's right down the road is like this, so we're kind of in line. Or maybe there was some kind of like average report that would come out that would say, yeah, average mortgage rates are 6.5. And so you look at your rate sheet and say, well, we're close. We're in that range. It's back to this transparency spectrum where before you were getting sort of like one or two anecdotes about what was going on in the market and you were having to make decisions around that, to today you have observations. We see tens of thousands of loans um, every week, every day, and now you have this a much more transparent view into the world around you as an originator, and so you can really fine tune your profitability equation. And ultimately that leads to more profitability for lenders. And then for consumers, right? I think the beauty of this too is the more transparent pricing data that's out there, it makes the market more efficient, right? You just talk about like transparency and a more efficient market. That's what this is doing. This additional data is going to make mortgage pricing ultimately more efficient, and it does lower the cost to consumers from a pricing standpoint because people are going to compete with each other and get more competitive and ultimately lower prices for the industry as a whole. So it's I think it's a really great, and I mentioned this at the top of the call. This is new, right? Like you couldn't 25 years ago, you didn't have the ability to observe this many loans. That data didn't exist anywhere. It didn't exist in servers anywhere because platforms like Optimal Blue didn't exist yet. So we're really at the cutting edge across many industries, certainly in the mortgage industry, of having enough data that you have a representative view into the market and can start making much more data-driven decisions. But all decisions are somewhat data-driven. I'm going to just say like representative data decisions, where you're really getting the ability to view kind of like a market as a whole, or so at least something representative. So that's where we're at today. And sorry, it's a little bit long-winded, but I wanted to provide some of that context to give your typical listeners a sense of what's going on in the mortgage industry.
No, I absolutely love that, and I've said a couple times on the podcast that I'm a huge Freakonomics fan, and that it has gotten me into learning quite a bit about not just kind of traditional economic theory, but some of the behavioral economic stuff. And as soon as you started talking about it, I was like, oh, this is a fantastic thing for everybody, right? Because it makes the market materially more efficient. Maybe not more liquid, but definitely the more transparent that the information becomes, the less room there is for wonky pricing, which is a good thing for everybody. What I'm curious about is, and good enough may be good enough in this regard, because it sounds like, when you talked about your market share and the things that you're able to achieve for your clients and for the consumers, where it's typically very rare that you can benefit both sides of the equation in that regard. I'm curious to know what the follow-up question is. Let me give a little bit more color on what I mean by that. We have this running joke among analytics consultants that's the client never knows what they actually want until you show them what they don't. So they'll tell me, hey, Ryan, we need you to build us X. And we go off and we build X, and they come back and they're like, that's interesting. Why did this go up? Why is this number so low? So whenever you provide analytics to someone that's like switched on and actually wants to like read and decide based on the analytics, there's always kind of that one or more of these follow-up questions. They're kind of, what's next? And I'm curious if you have a good handle on what your consumer's follow-up is. And if this goes into the area where it's like, hey, we're developing something, but we're not ready to tell the market about it, then, feel free. But what I'm curious to know is really, okay, so we have this really transparent pricing information. What is then the follow-up? Like, help us get into the mind of the person making decisions using this data.
Sure. I don't know that the follow-up is always the same, but I'll give some anecdotes here. And it's really the reason that there are follow-ups, specifically around this mortgage pricing question, is that it's multivariate in terms of what's contributing to what's going on. So
Yeah.
like to some extent, you don't know what you don't know until you start looking at the data. And then you naturally you'll see something and you'll say, well, that wasn't what I was expected. What's causing that? So I'll give an example. In mortgage pricing, you actually, as a borrower, when you go, and this is good in intel to have really for anybody who's looking for a mortgage, you have options when you're interacting with a lender. So you don't necessarily, like, if somebody says, like most people think, you go to a mortgage originator and you say, well, what's your rate, right? Like what's your rate today? The reality is you have choices at the time of origination as a borrower, and the originator, the loan officer, has choices for you as well. And sometimes they'll tell you about it and maybe they don't. But like a very key one is you can pay what's called discount points. So you can basically pay, like folks will know this as like paying down your rate. You have an option when you're going to get a loan from your bank or credit union or an independent mortgage. You could say, well, they might quote you 7 for your interest rate. And you say, well, I want better than that. I need something better right now. You could pay at the closing points in order to get a 6.5 or a 6 3/4. And so your decision making there, you have this option as a borrower, but then that becomes, when you think about it from the mortgage originator standpoint, they not only need to know that you can't just look at, like, for the whole industry, you can't just say like, well, what are the average rates being locked, or what is kind of like the rate distribution look like. You also need to know what price it's being locked at. And when I say price, I mean like, our borrowers paying discount points. So that changed. If you look at over time, when the Fed started raising rates in the spring of 22, folks are, not surprisingly, now on average paying a lot more discount points than they were, say, during COVID, when almost all loans were getting locked at par, no discount points, or even maybe above par, and then you get a lender credit. Then the lender can grant you some additional dollars at closing for origination costs. But now, for the most part, folks are locking below par. They're paying points to lock the loan. They're paying points to get that interest rate down. So you need to know that as an originator. You can't just say, what is like the average rate? You need to know what is the borrower behavior in the market right now, because maybe the rate that I should be focused on my own pricing isn't like the rate at par, but I should be focused on like the rate at, with a single discount point or 2 discount points, because those are the rates that are getting locked. And so you need to know, kind of like back to your economic theory thing, borrowers being willing to pay points sort of shifts the demand curve, and you need to know where that demand curve shifted. And so you have this dynamic where, back to your original question, is like, what would be a follow-up question? Well, I might put together a competitive analysis and say to an originator, here's the rates that are getting locked, and they'd be like, wait a second, those are way below my rates that I'm offering to the market. How is that possible? I know that I'm pretty good on margin, and I might have to come back and say, well, they're way below your par rates. They're not necessarily below your rates at like a discount point or 2, which is really where you should be looking, because that's where borrowers are locking right now. So that's a little bit of a niche detail, but I think it's a really good example of where you need to know, like, there might be multiple variables here, and you can't look at something in isolation. And so very often it's that the second question is, hey, what is another variable that might be contributing to this that I'm not thinking about?
Yeah, I absolutely love that color. I got a little bit of an education on mortgages there, so thank you for that, and for passing that on to all our listeners. But I think once I was coming into that question with the understanding of like, okay, well, you got like these like couple products, and each one has, its price or interest rate or whatever. Um, And it really opens that up where if you have more information, you can come in and you can say, all right, well, here is the par rate, but then, for this, we can offer this, and for this, we can offer this. So it allows that kind of deeper digging into not just here's one particular financial instrument, but here are all the different ways that we can change it and how the pricing would shift with that. And it really allows people on the origination side to operate the exact same as, maybe I would when we're talking about, oh, well, how do we want to approach this project or whatever. So I actually thought that was a phenomenal answer for, what the types of follow-up questions might be. And it gave us a really cool window into your space. So thank you for that. One of the questions that I love to ask everybody is, as we tend to have a bias to talk about things that are cool and exciting and that we're successful and or easily successful at. And I always like to ask guests, what is the hardest set of things that you're encountering in the data space right now, and how are you attacking those?
Yeah, absolutely. It's a great question, and it really ties in to something that you had mentioned earlier, which is disparate data sets. So there's a lot of different places that mortgage originators or folks in the mortgage industry at large might go for data sets, internal, external, publicly available, you know, something behind a paywall. And as we just talked about, you really want to be looking at a lot of these things uh, because there's sort of like dimensionality in any decision making. You want to be able to look at these different data points all in the same pane, right? You kind of want to be able to see it all together to help you make the decision. And so what we see though in a lot of cases are you've got one data report that sits in Excel, you've got something else that you log into a different software system to look at. Maybe you've got some other data that sits in like a SQL database, and you've got some team on Power BI or Tableau that works with it, or Domo is another really common one used in our industry. And so you have these disparate data sets. You have to look at them. They're in multiple places. You have multiple different people in some cases kind of like analyzing each of these different pieces of information, and they're not put together in kind of like a single report or single mosaic so that you can look at all of the data kind of in one view. And so I think that ultimately is the biggest driver right now of like pain, because I think the data, like for the most part, the data is there. Well, it's really exciting. Like the mortgage industry has gotten to this point where there really is good data out there, and you do just need to be able to put it all together in a coherent view that brings all of the relevant observations together. Just to double click on like the car example, it would be like you the car example, right? Like you from where you're sitting in a car, they make it so that you can see out your window, you can see all of your mirrors without having to like change seats, right? It would sort of be like having these disparate data sets. It would be like, yeah, you like while you're driving, you actually have to just like turn your head around to look behind you. Like there's still a window there, but there's a reason they put a mirror so that you don't have to move positions in order to see what's going on around you. So it'd be like if there was no rear view mirror and you just had to like turn behind you, that would be dangerous. So it's sort of the same thing with data in our industry. I imagine that's pretty similar across different industries, and I'm sure you run into that with your clients as well.
Yeah, absolutely. I'm glad we got one more bite at the car analogy apple. Um, yeah, I don't know what percentage, but it is certainly a very high percentage of the work that we do is structured around that concept. And whether that's getting the data or the reporting into a connected, easy to digest format, I do really think that at its most base level, the goal of analytics is to, as you talked about, any data is some representation of reality. And we want to distill that, apply focus or attention some measure of, appropriate memory. Like we're basically trying to hack the decision-making cognitive function to ensure that it has absolutely everything in exactly the right distilled format. Now, this is a very ideal, but I think the goal is to strive to try to achieve that with, incremental improvement and technology and all of that stuff. But where the rubber meets the road is when some person says, we're going to do this, and then they go out and they do it. And that is, hopefully beneficial to the organization. So everything is around hacking that. And I think getting, whether it's disparate data sets or, dozens and dozens of reports, which for everybody's, pleasure is pretty much the same as having no reports, right? Because if I don't know where to go to find the information, then that's pretty much equivalent to not having the information. But getting everything in one place and making sure that decision-making process is as quick, easy, and accurate as possible is the name of the game for everybody. So yeah, I think you hit the nail right on the head. That's the hard one. I think it will always be the hard one, at least until our AI overlords take over the world.
Yeah.
And put us all to a life of leisure or servitude. Who knows, right? Depends who you talk to.
Self-driving cars. Stick with the analogy.
Yeah. Brennan, I'm curious if we can get to know you personally a little bit better. Outside of being an analytics whiz, tell us a little bit about yourself.
Yeah, so you kind of gave a background. I started in kind of an investment banking, private equity role, and then moved into software, and then ended up in mortgage software, which I guess is kind of like a combination of finance and tech. So can't say that there was a coherent strategy there, but here I am. It all feels mostly relevant. In terms of like what else about me that's most relevant, I've got a Mary, I've got a toddler and another little one on the way, which is takes up the vast majority of my time when I'm not talking about rate lock data in the mortgage industry. I do have
Yeah.
I do have some in time, I guess, for sports. Like I'm maybe like an aspiring, like maybe like I want this to be like a sports podcast at some point. If you look at all the Packer memorabilia behind me.
Yeah, I was gonna say, I wonder what football team he follows.
Yeah. I'm sure folks won't have to take too many guesses to figure out that I'm sitting here in a Wisconsin basement. But yeah, I mean, I think between being a dad and a working professional, I think that takes up a lot of the time, and I think with a little bit of sports sprinkled in. I do want to. This isn't necessarily particular to me, but more for Optimal Blue and for folks that are interested in data, but broadly within the mortgage space, I think it's relevant here. We do a number of reports. So if you visit us optimalblue.com or find us on LinkedIn, we put out a number of reports. The prime one that folks typically in like the media will kind of focus on is called our Market Advantage. That's a monthly report where we look at everything related to mortgage rates, volumes, changes in credit, geographical differences around the country. So I think it's really relevant. It's certainly relevant to folks in the mortgage space, but we do absolutely, because the mortgage industry is and the mortgage business is so relevant to the macroeconomic picture. We do get a lot of hits from media. So our data gets referenced in the Wall Street Journal and a number of other, like the Federal Reserve tracks our data. So it's all data that I think could be pretty relevant for folks that are just interested in the macroeconomic picture, and even for consumers that are interested in like what the average mortgage rates are. If you go to our website, we have our own indexes, which are free and publicly available. If you just want to double check that you're getting a good rate, go check the Optimal Blue mortgage market indices. Those indexes are fairly well trusted by the industry. I like to tell folks we're kind of like the S&P 500 for mortgage rates, where our data is also used as the underlying value in a futures contract. So we think it's pretty trustworthy if folks are willing to put money on the line to hedge their business and leverage our data as kind of like the underlying there. So absolutely encourage you to track or find us on LinkedIn or optimalblue.com and catch some of that free reporting that we put out.
That's fantastic. That was going to be my next question. Is there anywhere else that, like let's say somebody wants to find out a little bit more maybe about what you're doing or your path or anything like that, that's a great place to reach out?
Yeah, absolutely. I mean, I mentioned our website and then LinkedIn, looking for Optimal Blue, but please do that for me personally too, Brennan O'Connell. So definitely find me on LinkedIn. Happy to chat data, mortgage, or I guess Green Bay Packer football. If folks want to know like good places to go if they're going to go to Green Bay, if they're going to go to Mecca for the NFL draft here in a month, then
Yeah.
happy to tell them about the right bars and restaurants. I'm actually from Green Bay originally, so I'm like part of the cult up there. So I'm absolutely happy to talk Packer football too if you want to discuss that. But yeah, please do reach out on LinkedIn. Happy to chat anytime. And the other thing I would mention, we do put out our own podcast, so you probably see that on the Optimal Blue website or the Optimal Blue LinkedIn page or my LinkedIn page. I usually repost, but we interview like every month. In addition to our monthly report, we'll interview kind of like a key guest, and a lot of times it's very mortgage specific, but other times we've got more of like macroeconomic or just sort of like well-known economists that will come on with us. So I think generally interesting, given how relevant mortgage is to the macroeconomic view.
Yeah, absolutely. Well, what's the name of that podcast for anybody that's looking for it?
Yeah, it's the Market Advantage podcast. So the monthly report and the podcast are both titled Market Advantage. So if you look up Market Advantage podcast by Optimal Blue or Market Advantage report by Optimal Blue, you should be able to track us down.
Yeah, that's fantastic for anybody that is also interested, like us, in some economic stuff, and in particular is looking, thinking, or working in the mortgage space. That sounds like an awesome opportunity. Brennan, you got to bring two of my favorite things that I get to do on the podcast together. One is learning a little bit more about a new niche of data, and the other is getting to talk, at least vaguely in an armchair expert kind of way, about economic theory. So thank you for providing those two opportunities and the excellent car analogy, which served us well all day today. In addition to, obviously your experience and your own unique path, I think that data and analytics has a lot of people like that. I also had like a weird path that I didn't expect would end me up here. And I think that those paths bring really interesting background and experience to task when we talk about analytics. So thank you for, taking that path and coming to analytics and building up this experience and then coming on the pod and sharing it with me and the listeners. Really appreciate it.
Appreciate you having me, Ryan. This has been a great dialogue from one Irishman to another.
What are you talking about? Ryan Sullivan is an Italian name.
Yeah, same with Brennan O'Connell. Yeah.
Yeah, absolutely. I also want to make sure to thank the audience, especially if you guys made it this far. Thank you so much for listening. If you like the episode, please make sure to go on, give us a subscribe, a like, a review, hopefully a great review. It really helps to keep the podcast cranking. We appreciate you listening and, maybe telling a friend about us. Brennan, I want to thank you again. Really appreciate you coming on. This has been another exciting episode of the Making Better Decisions podcast. Thanks for listening. That's a wrap for today's episode of Making Better Decisions. For show notes and more, visit makingbetterdecisions.live. A special thank you to our sponsor, Canopy Analytic. Canopy Analytic is a boutique consultancy focused on business intelligence and data engineering. They help companies make better decisions using data. For more information, visit canopyanalytic.com. There's a better way. Let's find it together and make better decisions. Thank you so much for listening. We'll catch you next week. Peace.